Jim, if you have to do a pre-mortem, so pre-mortem is, before things go wrong, what's going to go wrong? How does an investment here in Brookfield Asset Management, ticker BAM, or Brookfield Corporation, ticker BN, do poorly over the next 5 years? Thoughts?
Probably you can summarize the thoughts in one word. That word's leverage. They are not strangers to leverage. They're not unaware of the benefits of leverage. They've had a lot of really cheap leverage to purchase assets in the past decade and a half of zero interest rate policy. So they've got there's a lot of borrowed money out there, and the cost to roll that borrowed money is, of course, rising recently. Although I see this morning, someone I believe in U.S. government, or at least high in the investing world, observing the U.S. government, said that the U.S. Fed is done raising for the year, which wouldn't shock me, frankly. Canada stopped a couple of interest rate hikes ago. You guys have done a couple since we finished. Probably going to hold out for a while. So the leverage pressure may be spelling off of the Brookfield entities, but that's where I would guess if there is going to be a problem. And especially to the commercial real estate stuff. I mean, there's a lot of smoke around that area. If we are having work from home and a lot of office towers end up with 35% vacancy, that could make people that own said leveraged office towers could make it more difficult for them. So that's where I would go. I'm not sure that see pre-mortem or post-mortem. I mean, the word death is literally in there, right? Or dead. I'm not sure I would look at. I'm not sure I would be predicting. I don't think you can kill these companies. I think what a disappointing outlook might look like, Dwight Schrute, if that's your real name. I think what it really looks like is probably stagnant returns, or you might come back in 5 years and your annualized return is -5% while the market's gone up 8 or 9% annualized. That would be a disappointing outcome. Not the least of which is because Brookfield is in my top 3 holdings. But that would be a disappointing outcome. But I'm reasonably certain, as much as you can be with such things, I'm reasonably certain that this is not a company that implodes on itself from the type of leverage, rather that it just becomes that it struggles and stagnates in a higher interest rate environment, or in an environment where people have options. They can go elsewhere for their investment returns. Now the fixed income market might be a little sexier than it was, say, 2 years ago. So, but that's where I would look. But I've not seen any evidence of that hindering them. Again, these are some of the smartest people in Canadian and worldwide finance. They know how to run a business. They generally have most of their debt facilities, I believe, fairly isolated from one another. So a lot of project-specific debt and that sort of thing. There's, of course, all the different tendrils of all the different businesses, so you can pick and choose where you want to invest in the Brookfield empire. But yeah, I'm not terribly worried about. Not terribly worried about Bruce Flatt driving this over a cliff. I'll put it that way. But maybe he disappoints from here.
Yeah, and just a note on the the leverage thing, and kind of to underline what Jim said about fixed income is sexier, is what he is saying is interest rates have increased, and so things like bonds are much more attractive as a potential investment asset for income than they have been in years past, because of, again, 5% higher than 2%. Very simple math there. And when you were competing with a 2% alternative, now you're competing against a 5% alternative. That's a harder competition. B, use a lot of leverage when it comes to financing some of these assets. So when your cost of capital goes down and the people you're competing with to get capital flows to you, their returns go up, that can potentially create a challenge for the business. However, one thing that is interesting with Brookfield vis-a-vis leverage is, often the reason you see interest rates going up, why you're seeing interest rates going up right now, is because of inflation. You're trying to combat inflation and bring it down. And at least for Brookfield Infrastructure Partners, the vast majority of cash flows are tied to inflation, such that their cash flows increase while their debt remains at a fixed rate. So you could argue, at least over the near term, if rates go up forever, it's bad for the company. But if rates go up and stop, and their capital structure remains constant, there actually can be some tailwinds to the company from increasing inflation, because the interest rate bump ups occur while their debt that they've taken out in the past remains at a fixed rate. So there's lots of puts and takes here with the company. But essentially, if cost of capital goes up and flows go down, you may be inflows of capital to the company slow down. That could be a potential headwind for the business. But do I think we're going to come back in 5 years and Brookfield isn't on the short list of companies to own and manage infrastructure assets on a global basis? I think it's very unlikely that that's going to change.